Assalamu alaikum, my dear students, I hope to be fine. In this lecture, I am going to talk about the most interesting topic, which is investing in stocks and bonds. Firstly, we will talk about the main features of stocks and bonds. In this regard, we should understand main issues including cash flow rights and maturity, legal relationship between the issuing company and the holder of each security, types, other features, and valuation. To understand the difference between stocks and bonds much better, we suppose that there is a dialogue between one of you as an investor and a financial advisor who works in a brokerage company. You begin this dialogue with a question: what do you mean by stocks and what do you mean by bonds? Your advisor told you if you buy common stocks, you will be owner in the issuing company. So if you bought 100 shares of Telecom Egypt, you become owner in Telecom Egypt company. Most companies issued their shares at par value. Say, if Telecom Egypt issued their stocks at 10 Egyptian pounds for each share, so your equity will be recorded in the financial statements of Telecom Egypt, your shares equivalent to 1,000 Egyptian pounds. You bought 100 and the par value of each share is 10 Egyptian pounds, so your equity is 1,000 Egyptian pounds. But if you buy a bond, you will be lender to the issuing company, which means you will have a claim on this company. If you put most bonds or issued at face value of 1,000 Egyptian pounds if it is issued in Egyptian stock exchange. So if you bought just 10 bonds, you have a claim of 10,000 Egyptian pounds on the issuing company. So if you buy a bond, you will be lender, you will be creditor, and the financial company has financial obligations for you equals this amount. How I can buy it? The investor asks his financial advisor how this investor can buy stock or bond. The advisor told you can ask my brokerage firm to buy on behalf of you. So the brokerage company will buy the required number of shares at market price in stock exchange, stock market in which shares of Telecom Egypt and other companies are traded. And in the same way, if you want to buy specific number of bonds of any issuing company, you can ask brokerage firm to buy on behalf of you, and the brokerage firm will buy the required number of bonds at the market price in stock exchange. Stock exchange, call it stock market, which is a capital market. So, what kind of cash flow you will receive if you buy stock? If you buy stock, you will receive cash dividends. Why? Because you are owner in this company. So you will take at the end of each period % of net income. But if the board of directors of this company decided to not distribute cash dividends this year for any purposes, because they will do expansion in the business, or because they will repay large portion of their debts or other purposes. There is no legal obligations for you against the company. But in case of bond, you are creditor, you are lender, so you will receive interest like bank. In case of granting this company loan, the bank will receive interest payments. You will receive interest payments like the bank. The bank play as a creditor on the company, and you also as a creditor to the company. So you will receive interest payments from the issuing company if you bought its bond. Interest is calculated as percent of face value. Usually is a fixed coupon rate, and you have full legal obligation against the company if it defaulted to pay the interest payment at the specified date. When you will receive cash flow? Actually, if you buy stock, you will receive non-periodically dividends. It's up to the decision of board of directors to distribute 20% of net income, 30% of net income, or not to distribute any cash dividends. And if they distribute cash dividends this year 10%, there is no condition to distribute the same percent next year or above or below. So you may receive constant dividends or constant growth rate of dividends. Your dividends may increase by 5% annually, or non-constant growth rate. Your dividends increased from year to year, but at non-constant growth rate. In case of bond, usually you will receive periodical fixed coupons. It may be annual coupon payments or annual interest payments, semi-annual coupon payments, or quarterly coupon payments. Most bonds pay semi-annual coupon payments. As we said before, the coupon payment is calculated as a percent of face value. Most bonds issued at fixed coupon rate, but there is some bonds issued at floating coupon rate, and some bonds issued at zero coupon rate, which means it issued at discount, like treasury bills. Okay, how long I can receive cash flow? It depends on the life of security. In case of stocks have infinite life, but bonds have limited maturity. More specifically, if the bond has maturity of more than 10 years, it is called bond. But if bond has maturity of less than 10 years, it is called notes, not bond. What types of the issuing institutions? In case of stocks only issued by companies, corporations. But bonds can be issued by governments, and they call it treasury bonds, and they can be issued by companies, and they call it corporate bond. Can the stockholders and the bondholders have rights on the issuing company other than cash flow? Yes. Actually, stocks have voting rights. Voting rights means you can vote as a stockholders. You can vote on critical decisions, like if your company want to do merger or acquisitions. You can vote on these critical decisions. But if you are a bondholder, you don't have any voting rights on such critical decisions. But you may have covenant. Covenant is restricted rules or limited actions on board of directors, like dividend ratio and debt ratio, by which this covenant, which is restricted rules, restrict or obligate the board of directors of the issuing company to don't exceed dividend ratio, specific dividend ratio, like 40%. The board of directors cannot exceed 40% of dividend to stockholders, because they issued bonds and they agree with bond holders about the dividend ratio doesn't exceed 40%. And by the same way, debt ratio. For example, the board of directors can be obligated to don't give any extra loans above 30% or 40% of capital structure. So this restricted actions called covenant, and some issues of bonds give bondholders this right. What if the issuer bankrupted? In case of stocks, if the issuing company bankrupted, it will sell its assets. So it is called liquidation. You have a residual claim on the company's liquidated assets. Residual claim means you are the last part receiving his claim or his equity in the company, which means in case of liquidation, the company will pay firstly banks. It will sold its assets and pay first of all bank loans, and then it will pay bond issue, and then it will be pay for preferred stocks, and the remaining amount of liquidated assets will be distributed for stockholders, common stockholders. So you have a residual claim. But in case of bond and the issuing company is bankrupted, the liquidated assets will be distributed first for bank loans and then for bondholders. So bondholders have seniority in receiving their claims than stockholders. Other features of common stocks. Common stocks may or may not be issued with par value, and shares of public companies traded on stock exchange. So there are two types of corporations: privately held corporations and publicly held corporations. Privately held corporations means the ownership of this company is owned by a few number of shareholders, and shares of this company are not traded and are not listed on a stock exchange. But publicly owned corporations, its ownership is owned by a large number of shareholders, and their shares are traded on stock listed and traded on stock exchange. The corporations can issue several classes of common stocks. Each class has its specific cash flow rights and voting rights. There are other features of bond called bonds with embedded provisions. The first provision is called conversion provision, which gives the bondholder the right to exchange the bond for a specific number of shares. For example, one bond of 1,000 Egyptian pounds face value can be converted to 150 shares of the issuing company. So if you have a bond issued by Telecom Egypt and its face value is 1,000, you have conversion provision on this bond to convert the one bond into 150 shares of Telecom Egypt. The second provision is call provision. Call provision gives the issuer or the issuing company to buy back the outstanding bond. If the bond has 1,000 face value, it can buy or call this bond of 1,000 face value from the bondholder, but at pre-specified price, called call price. For example, it can buy back 1,000 face value bond at 1,050. So bondholder will get 50 Egyptian pounds as call premium. Put provision give the bondholder the right to sell back the bond of 1,000 face value to the issuing company at a bought price. Usually, bought price is set at lower price of face value. If the bond market price reaches this price, the bondholder can sell back this bond at 850 because of the possibility to decrease less than 850. In the last slides, we talk about features of common stocks and features of bonds. But there is another type of stocks called preferred stock, and sometimes it is called hybrid security. Why? Because preferred stock has some features of common stocks and some features of bond. First of all, preferred stocks means this stock has preference on common stocks in receiving dividends and in receiving their equity in case of liquidations before common stocks. First of all, preferred stock has cash flow, fixed cash flow. Preferred stock provide its holders fixed dividends, which is similar to bond in providing fixed income in form of interest payment. So preferred stock has these features like bond in providing its holder a fixed income. But this fixed dividends doesn't mean the preferred stockholders have legal obligation for this dividends, which is similar to common stocks in providing dividends. So preferred stockholders haven't legal obligations against the issuing company in case of doesn't paying dividends. Preferred stocks can be cumulative or non-cumulative of missed dividends. Cumulative means if the firm this year doesn't pay preferred stock dividends, and the next year it will pay dividends in arrears, which means it will be pay dividends for the last year and for the current year. Non-cumulative of method dividends, if the firm in this year doesn't pay dividends, and in the next year it will pay the dividends for its current year only. It will not pay any dividends for the last period. As we said before, preferred stocks have a higher claim on liquidated assets and a claim for any unpaid dividends. But preferred stocks have no voting rights like common stock holders. Common stocks have voting rights, but preferred stocks have no voting rights and have no ownership. Preferred stock issued with assigned par value, but common stocks may issued at par value or may issued at no par value. Preferred stocks have some features of bond, like it can be redeemable at pre-specified price, like call provision in bond. And preferred stock can be convertible into specified number of common shares, like conversion provision in bond. Preferred stock can be issued in several times, so it is called multiple preferred stock issues or rounds, like common stocks. One firm can issue different classes of common stocks, class A and class B. For each class, the owner or the shareholders have different cash flow rights and voting rights.